The largest US banks are expected to reveal this week that customers withdrew tens of billions of dollars in deposits at the start of this year 2023, even as they gained new customers following the collapse of Silicon Valley Bank. Analysts are forecasting that depositors seeking higher interest rates from alternatives such as money market funds pulled almost $100 billion in aggregate from JP Morgan, Bank of America, Citigroup and Wells Fargo in the first 3 months of this year 2023, according to consensus data compiled by Bloomberg. If correct, it would come despite the failures of SVB and Signature Bank in March of this year, which spurred customers to move deposits from smaller regional banks into bigger ones. Deposits are typically banks' cheapest source of funding, and a reduction could constrain lending. The big banks have steadily been losing deposits for the past 12 months as the Federal Reserve has raised interest rates. So JP Morgan, Citi and Wells Fargo report earnings on Friday the 14th of April 2023, followed by Bank of America on Tuesday the 18th. Goldman Sachs and Morgan Stanley, which have businesses that skew more towards investment banking, trading and asset management, report on April 18th and 19th respectively. On average, first quarter revenues at the big six US banks are expected to rise just over 6% year on year, while earnings per share are expected to increase by just over 1% according to Bloomberg estimates. Analysts expect revenues will rise the most at the banks with large retail operations, namely JP Morgan, Bank of America, Citi and Wells Fargo. Investment banking is expected to have suffered another challenging quarter as Wall Street grapples with a prolonged deal-making slowdown that is expected to hit Goldman Sachs and Morgan Stanley hardest. Trading revenues are also likely to be down year on year, but will remain at very healthy levels given recent volatility in financial markets, analysts expect. Before the SVB and Signature collapses, deposits had been flowing out of the banking system into higher yielding assets like money market funds, because many banks were not passing on higher interest rates to depositors. So these are some of the funds, some of the instruments where some of those deposits have been going to. You can see that minimum investments, and some of them is like $1 million, though some of them have minimum investments of nothing, anything at all can come in there. And you can see that it's just the next step is to buy. So and all of these are on Charles Schwab. Okay, so these boosted profit margins from lending with both withdrawals put pressure on banks to lift their so-called deposit betas, which measure how much of any rise in interest rates lenders expect to pass on to customers. If rates remain high, banks will either have to make do with lower levels of deposits or begin offering customers higher rates. Margins are under pressure because the deposit bets are accelerating, according to Betsy Grashtek, research analyst at Morgan Stanley. The deposit flight at big banks during the first quarter is expected to have been partially offset by a rush to safety by customers in the wake of the collapse of SVB. Recent data from the Fed shows that since March 8, when fears about SVB's viability hit fever pitch, the largest 25 American banks pulled in roughly $73 billion. Smaller banks with less than $85 billion lost about $206 billion over the same period. Customers pulled $100 billion in the first quarter from the largest US lenders, analysts project. So US banks, or rather Wall Street, is set to hear the reports as it concerns the run on deposits from the US banks. See what you make of all of these, and I'll continue to update you. Thank you very much for watching this video.